If you have more than $25,000 sitting in any savings account right now, the IRS already has a report about it. Not because you did anything wrong, not because you filed incorrectly, because your bank sent that report directly to the federal government in January, in February, and every single month after that, without saying a word to you about any of it. And here is what makes this different from every other IRS warning you have ever heard. It is not the balance they are watching. It is what that balance is generating. The interest on your own savings account is quietly triggering 3 separate IRS events at the exact same time, and every one of them costs you money you did not know you were losing. This is not a warning about something that is coming. This is a warning about something that has already happened this year. It happened this tax year. It is happening right now in savings accounts across all 50 states. And almost nobody over the age of 60 has been told any of it. In the next 22 minutes, I am going to show you the exact dollar threshold at which your savings account starts working against you. The 3 IRS events that trigger automatically when you cross it. The government form your bank filed on you without your knowledge and what it contains. The hidden Medicare surcharge that most savers never see coming until it hits their premium statement, and the 5 moves that financial planners use to protect their own money from every single one of these traps. If you have money in a savings account, a money market account, a certificate of deposit, or a high-yield savings account at any bank or credit union in the United States, watch this entire video before you make another deposit. Before I get into the numbers, I need to tell you about someone I know. I am going to call her Patricia. Patricia is 66 years old. She is a retired registered nurse from outside of Charlotte, North Carolina. She spent 31 years working in a hospital cardiac unit. She retired at 64, started collecting Social Security at 65, and she has a savings account at the same credit union she joined when she was 29 years old. Patricia was not wealthy. Patricia was disciplined. Her whole career she lived below her means, put money aside every month, and by the time she retired, she had built up a savings balance of just under $90,000. That money was her security. It was the cushion that was supposed to let her sleep at night. Last spring, Patricia got her tax documents in the mail. She spread them out on her kitchen table the way she did every year and started adding up her income. Social Security, a small pension, and then she picked up a form she had never really looked at closely before. It was a 1099-INT from her credit union. The number on that form was $4,218. That was the interest her savings account had earned in the previous year. Patricia thought that was good news. She was wrong. That $4,218 did not just add to her income. It triggered a chain reaction inside the IRS tax code that cost her $11,300 in taxes and Medicare surcharges she had no idea were coming. Patricia called the number on the back of her Medicare card to ask why her premium had gone up. The representative told her a new income bracket had been applied based on her tax return from 2 years prior. Patricia did not understand what that meant. She still does not fully understand what happened to her. And that is exactly what I am here to explain today, because what happened to Patricia is happening to millions of American retirees right now, and almost none of them understand why. Here is the rule that almost nobody explains clearly. Every single financial institution in the United States is required by federal law to report interest paid to any account holder directly to the IRS. That report is called a Form 1099-INT. It is filed automatically. It is filed on every account. There is no minimum threshold for this report. 0. If your savings account earned $1 in interest this year, the IRS got a Form 1099-INT telling them about it. If it earned $4,000, they got that form. If it earned $12,000, they got that too. The form includes your full legal name, your social security number, your account number, and the exact dollar amount of interest paid. It goes directly from your bank to the Internal Revenue Service before you ever sit down to do your taxes. That means the IRS already knows your interest income before you report it. And if what you report does not match what your bank already told them, that discrepancy is flagged automatically. Now, here is where it gets expensive. That interest income does not just add to your taxes the way a regular paycheck would. For retirees collecting Social Security, it does something far more damaging. It increases what the IRS calls your combined income, and that combined income number is the single most important number in your entire tax return if you are retired. Most people have never heard of it. Here is how it works. The IRS takes your adjusted gross income, adds any non-taxable interest you earned, and then adds exactly half of your annual Social Security benefit. The total is your combined income. There are two thresholds written into the tax code. If your combined income exceeds $25,000 as a single filer, up to 50% of your Social Security benefits become taxable. If it exceeds $34,000, up to 85% of your Social Security becomes taxable. For married couples filing jointly, those numbers are $32,000 and $44,000. Those thresholds have not been adjusted for inflation since 1983, not once. In 1983, those thresholds were designed to affect only the wealthiest 10% of retirees. Because Congress has never indexed them to inflation, they now affect more than 56% of everyone collecting Social Security. And your savings account interest is one of the most common triggers pushing ordinary retirees across those lines without them realizing it. I want to pause here because what I am about to describe is the specific sequence that destroyed Patricia's tax year, and it is the sequence that is happening silently to savers across this country right now. Patricia's Social Security benefit was $22,400 per year. Her pension was $11,600. Her savings account interest was $4,218. Her combined income total was $37,818. That put her above the $34,000 threshold, which meant 85% of her entire Social Security benefit, not just the excess above the line. 85% of the full $22,400 became subject to federal income tax. That is $19,040 of income she previously paid zero tax on suddenly being added to her taxable income because of $4,000 in savings account interest. The additional tax on that amount was $3,211, and that was just the first hit. The second hit was something Patricia had never heard of. It is called the Income-Related Monthly Adjustment Amount, and it is the Medicare surcharge that the government has buried inside the fine print of your premium statement, where almost nobody finds it until it is already too late. Here is how it works. The Centers for Medicare and Medicaid Services looks at your income from 2 years prior when calculating your current year Medicare, Part B and Part D premiums. If your income crossed certain thresholds, your monthly Medicare premium goes up. It goes up automatically, without warning, without a letter explaining why. The standard Medicare Part B premium in 2026 is $174.70 per month. If your modified adjusted gross income exceeded $106,000 as a single filer or $212,000 as a couple in the tax year 2 years ago, you pay more. But here is where it catches ordinary savers. The first surcharge bracket starts at just $88,000 for singles and $176,000 for couples in 2024 tax years, affecting 2026 premiums. For Patricia, her income after the Social Security recalculation crossed a threshold she did not know existed. Her Part B premium jumped from $174 per month to $244 per month. That is $69.30 more per month, multiplied by 12 months, multiplied by 2 because she pays for Part D as well. Patricia's Medicare surcharge alone was over $2,000 for the year. Add the $3,211 in additional income tax from the Social Security recalculation. Add the federal income tax on the interest itself. Patricia paid $11,300 more than she would have paid if that interest had never existed. And the interest itself was only $4,218. She paid more in taxes and surcharges than the interest she earned. Her savings account had a negative real return after taxes, and her bank never told her any of it was coming. And that is only two of the three events. The third one is the one nobody talks about because it does not show up on a tax return and it does not send you a letter. It happens inside the compliance software at your bank. Here is the mechanism. When your savings account balance crosses approximately $25,000 at most retail banks, your account automatically enters a higher risk monitoring tier. That is not a law, that is a bank policy. But it is a bank policy that has direct consequences because the transaction patterns associated with higher balance accounts are flagged and reviewed more frequently by the bank's compliance team under Bank Secrecy Act obligations. A withdrawal that would have cleared without any review on a $10,000 account triggers a compliance queue review on a $90,000 account. And if you are drawing down that balance, taking out money in amounts that the software interprets as pattern-based, you now have a structuring flag sitting next to an IRS interest report, sitting next to a Medicare surcharge calculation, three separate government and institutional events all triggered by one decision: keeping your money in a savings account that pays interest. The bank does not call this a trap. The bank calls it their standard compliance protocol. But the result for you is the same. So what do you actually do about it? Because the purpose of this video is not to scare you into moving your money somewhere dangerous. It is to show you exactly how the people who understand these rules manage their own money differently. There are 5 moves that address each of the 3 events I just described. Move number 1 is the Roth conversion window. If you are between the ages of 60 and 72 and you have not yet started required minimum distributions, you are sitting inside the most valuable tax window of your retirement. This is the period where your income is lower than it will be once RMDs begin, and where converting money from a traditional IRA into a Roth IRA can reduce your future combined income permanently. Every dollar that sits inside a Roth IRA earns interest that is completely tax-free and does not count toward your combined income calculation at all. A Roth account does not generate a 1099-INT that the IRS uses against you. It does not push your Social Security toward the 85% bracket. It does not affect your Medicare premium. Converting $50,000 from a traditional IRA to a Roth over a 3 to 5 year period is one of the most effective moves a retiree can make to permanently reduce the number of IRS events triggered by their savings. The conversion itself is taxable in the year you do it, but you pay a known controlled amount now to eliminate an uncontrolled compounding amount later. Move number 2 is the ladder instead of the lump. The mistake Patricia made was not earning interest. The mistake was letting all of her interest land in the same tax year at the same time in the same account. A Treasury bill ladder solves this problem because you can control exactly when the interest income lands. A 12-week Treasury bill purchased in October matures in January of the next tax year. The interest on that bill is reported in January, not December. By staggering your purchases across the calendar year and into the next, you control the timing of your 1099-INT income the same way a business controls the timing of its expenses. And Treasury bills have one additional advantage that most savers do not know about. The interest they pay is exempt from state income tax. If you live in a state with a high income tax rate, a Treasury bill earning the same nominal rate as a savings account puts more money in your pocket on an after-tax basis every single time. Move number 3 is the qualified charitable distribution. If you're over 70 and a half years old and you give money to a church, a charity, a food bank, or any qualified nonprofit, you can direct up to $105,000 per year from your IRA directly to that organization as a qualified charitable distribution. That distribution satisfies your required minimum distribution for the year. It reduces your adjusted gross income by the full amount of the gift. And because it never touches your bank account or your tax return as income, it never adds to your combined income calculation. It never pushes your Social Security further into the taxable zone. It never crosses a Medicare surcharge threshold. Every dollar you give this way, instead of taking as a normal distribution and then donating as a dollar, the IRS never gets to use against you. Move number 4 is the account separation strategy. If your goal is to reduce your bank's compliance monitoring on your primary account, the answer is not to take money out in ways that could look like structuring. The answer is to move the balance above your operating needs into a separate institution entirely. A brokerage account at Fidelity, Schwab, or Vanguard does not operate under the same retail bank compliance algorithms. It does not have the same suspicious activity reporting triggers on routine transactions. A retiree with $60,000 in a brokerage money market fund earning the same 4.5% as a high-yield savings account is not generating compliance flags at a retail bank every time they move money. They are operating in a different regulatory environment with different monitoring thresholds. Keep 3 to 6 months of expenses in your primary checking account. Keep 3 to 6 additional months in a high-yield savings account. Move everything above that number into a brokerage account where the compliance environment is designed for large balances and complex transactions, rather than for retail customers making routine deposits. Move number 5 is the IRMAA appeal. This one is for anyone who has already received notice that their Medicare premium has increased due to income. Most people do not know that Medicare allows you to appeal an IRMAA surcharge if your income has decreased since the tax year being used for the calculation. The form is called a Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, SSA 44. If you retired in the current year, if you lost a spouse, if your income dropped significantly for any reason, you can file that form and request that Medicare use your current year income instead of the 2-year-old income on file. The Social Security Administration must review that appeal within 30 days. Thousands of retirees are paying surcharges they are legally entitled to have removed, and they are not removing them because nobody told them the appeal existed. Patricia eventually sat down with someone who knew these rules. She filed the IRMAA appeal using her current year income, which was lower because she had already begun the Roth conversion process. Her Medicare premium came back down. She moved the bulk of her savings balance into a treasury bill ladder across 2 different maturity windows to spread the interest income over 2 tax years. She opened a Roth and began converting a portion of her traditional IRA every January. In the first year after making those changes, her combined income dropped below the $34,000 threshold. 85% of her Social Security was no longer taxable. It was 50%. Her tax bill on the same income dropped by $4,022. Her Medicare premium came down, and for the first time in 2 years, her savings account was actually working in her direction instead of against it. She told me the thing that made her the most upset was not the money she had lost. It was that her bank had sent the government a report about her interest income every single year and never once sat down with her to explain what that report would cost her. Not once. If you take one number from this video, take $25,000. That is the approximate balance at which a standard savings account at a retail bank starts triggering all 3 of the events I described today. Below that number, the interest income is usually small enough that it does not move your combined income across a threshold. Above that number, every additional dollar in interest is potentially pulling Social Security income into taxable territory, nudging your Medicare premium toward a higher bracket, and placing your account into a higher compliance monitoring tier. $25,000 is the line. Anything above it belongs in one of the account types I just described. managed in a way that gives you control over when and how that income appears on your tax return. The IRS is not going to call you and walk you through any of this. Your bank is not going to call you either. They profit when your money sits there earning interest that triggers events they will never explain. The only person who can decide to manage this differently is you. If this video helped you understand something your bank never explained, share it with one person you know who is over 60 and still keeping most of their retirement savings in a standard savings account. That one share might be worth more to them than anything their bank has told them in the last 20 years.